So, Tuna, let's start with the good stuff here, then maybe try and figure out why this market is fading the news, because on the big 15, or actually it was closer to 16 million subscriber ads, we were up like 13% at one point overnight.
That's right. I think, I think the market is actually digesting some of those numbers. And, there's no way to really describe this quarter's blowout, way above even the most optimistic expectations. We knew going into this quarter that, COVID-19, the stay home, is going to spike home viewing. And that's what we saw. Netflix has obviously one of the main beneficiaries. When you look at, how the shares have kind of, traded through this situation, I think most people expect that, there's going to be benefits, and even with the streaming wars. But the valuation question that we've gotten quite a bit, we still feel like even at these levels, there's a lot to be said about, how this whole situation is going to play out in terms of the forecast for Q2, 7.5 million. We think that number could well be conservative. What we liked actually was the fact that the gains that we saw were kind of broad-based across all geographic regions. So we've heard some, theses about potentially this quarter having some pull forward impact. But even if that were the case, I would argue that there's a lot of people that have discovered Netflix now, in captivity, I might add, that will stay on even when all of the dust settles. So when you have 16 million net ads in any quarter, that is a number that I would take any day of the week.
Now, the numbers here, as they translate into the bottom line, how much clarity do we have on Netflix's ability to continue to churn out profit and accelerate the rate at which those revenues turn into profit? Is this an enterprise that is going to be able to be a huge cash cow?
Well, on that question, Oliver, I think one of the things we like is the fact that, which is paid little attention, is the fact this last quarter, actually the cash position was a positive for the first time in Netflix's history. Granted, that was partly due to the fact that there was delays in the content spending, which actually the company explained was not necessarily due to the COVID situation. So while the free cash burn outlook has been ratcheted down for this year, we think the path to positive free cash flow is actually looking better. To your point, Netflix has been profitable for quite some time, but investors seem to be honing in on the positive free cash inflection. So the underlying trends, having all these consumers join and paying, as it were, and enabling the company to build cash and grow its revenue, increasingly offsetting the content and marketing spending. Those are recipes that you want to see on your trajectory to free cash, positive.
Yeah. Is there I think this is a really interesting point, too. And I mean, is there something they can learn here from this situation, that maybe they don't need to produce as much new, fresh content? It seems like the onus has been on them to produce as much and as high quality as possible. Of course, that's led to huge outlays in CapEx throughout the past several years as competition has mounted. But do we see that this quarter, given the forced quarantine and inability to do that maybe they can find a suite that they already have to rely on that a little bit more? Can they dial down costs?
Well, I think Netflix actually in an enviable position, as kind of ironic as that sounds now, because they tend to release all of their episodes almost all at once. At this point in time, they're sitting quite pretty in terms of their content slate for the rest of this year. And that's not something a lot of competitors can say with all of the halted production across the industry. With that being said, the longer this COVID outbreak goes on, at some point next year is going to start to have an impact. So I would say to your question that the content pipeline right now, at least through the rest of this year, is looking very, very good, in no small measure due to the company's business model. As far as whether they need to dial back on content, we don't really expect that to be a good strategy, because content, as you know, is the lifeblood of this streaming wars, and especially original content that kind of helps you to create your brand. We still expect them to end up this year well over what they spent last year in cash, content costs, and accelerating, thereafter, especially with all these new competitors, breathing down their necks. So this is something that's already built into the business model, and which we think is well accounted for in the trajectory to free cash flow, positive free cash.
Yeah. All right. So we've got positive free cash flow for Netflix. This is an important moment, and it seems that as they have also carved this moat back around themselves, Tuna, does the narrative need to change? Because we've heard a lot of folks say, hey, Disney is at a huge advantage because they don't need to spend anything additional for their streaming. I mean, they do, obviously, but the fact that they have this huge catalog is supposed to be a leg up. And, again, I know that this demographic is split kind of on whether you have kids or not have kids, but the news flow has been 100% that I can see concentrating on Netflix during this period.
Right. I mean, that's a great point. And I would add the fact that, the secular trends that have been driving this, this landscape remain intact. What we didn't foresee was that the stay-at-home quarantines is going to provide some type of catalyst that will reinforce this business model even more. So to your point, with all these Disney and everyone else jumping in, as you saw Disney, reporting 50 million global subscribers in just a few months. I think there's enough, to go around here. The pie is large enough that Netflix and Disney can both be winners, or among other potential competitors. I think what's important to remember here is that even while the U.S. market is relatively saturated, and we think the potential in international markets, the addressable market, north of 800 million broadband, households outside the U.S., which is, less than a quarter penetrated. And that's a huge upside that we're talking about here. So even in the U.S., Netflix adding, the subscriber additions that they just had this quarter, I mean, just tells you that there is a pent-up demand, even within the U.S. And this is all about search and discovery and personalization. And the more that people discover content that they like, the more they're going to get hooked. I mean, you saw this last quarter, Tiger King, Love is Blind, all of these shows with huge, viewership, really knocking it out of the park. It only takes one or two shows for you to get hooked and then find out other shows that you like. And that's why you kind of see churn become even more manageable despite the price increase that they have implemented lately.